let's try some pricing now. So the required return on capital will be given. So I'll give you that in the formula. We'll maybe talk a little bit more how we got that. Required net worth, there's all these approaches. We're going to use a very specific formula. We're going to use a surplus ratio. I'll show you that. The expenses, that comes forecast from the CFO. The actuaries look closely with them to see what expenses for policy service, for claims administration, everything, accounting, actuary, all the expenses that are associated with the product. Expected losses in LAE, we're going to be using frequency and severity. Remember, frequency is a number of claims, severity is the average claim amount. The investment return float, this is the second thing I was responsible for when I worked with the actuaries. I had to come up with the KE and I had to provide to them if we got premiums in today, what rate would we make today? So that will be given to you. All of these numbers actually be given to you. So we're finding a premium that, given all of this input, required net worth, expenses, expected losses, our expected investment return, what premium meets the return on equity requirement. So we're going to use trial and error. On the exam, the way I've done it in the past is give you two premiums and you pick the one that better meets the requirement. I don't know how I'm going to do it with an open book final, so we'll figure that out later. I'll make it really clear before the exam what we're going to do. The actuaries actually use a formula, and it's beyond the scope of this class. And really, I'm not an actuary, so it's hard for me to deal with some of the actuarial formulas. The actuaries, we will see some of this stuff on your later exams. But your goal, and we'll do that in this class, is your goal is not necessarily to set a premium, but to set the percentage change in the premium. How much will your rate increase this year versus last year? And so we'll show that. That's pretty straightforward to do. So if you do all the work, so here, let me give you some cynicism here, but this is absolutely true. Let's say you do all the work and your solution says you need a 12% premium increase. So I did that with the actuaries. All right, we need 12% in the state of Georgia. And they file a request for 5%. So I'm asking, well, we have all this paperwork, it's a really thick package of work. Our solution is 12%. Why are you filing 5%? And they file 5% because they know that's the most the regulators will allow them. So you ask for 5% because that's all the state will allow you. So what does that mean when you have a really good year and you can ask for a 5% reduction? In that case, you still ask for a 5% increase to offset all the losses you had in previous years. So I did many of these where the answer was always 5%. But that is the final thing you file with the state, is what percentage increase do you need for this year versus last year. Remember that underwriting gain is your premiums minus your claims minus the LAE minus expenses. All right, so here's the capital ratio we're going to use. We're not going to use a risk-based capital formula. Instead, we are going to use a very popular one in the industry, which is the surplus to ratio, premiums to surplus ratio, or the surplus ratio as we call it. So premiums to surplus, for every $3 we have in premiums, we want to have $1 in net worth. So let me explain. Surplus here is the same thing as net worth. It's on a statutory basis. We'll talk about that later. It's not a GAAP basis. So that's what we mean by surplus. Surplus ratio is another way of saying capital ratio. But here we're going to say for every $3 you have in premiums, you have $1 in net worth. Risk-based capital will be better, but I'm just simplifying things. The problem with the 3-to-1 ratio is it ignores what business mix you have. You can write at a much higher ratio, like 5-to-1 if you're doing auto, and you might actually need 1 or 2-to-1 to do homeowners. So it assumes homeowners and auto are the same risk and they both require a 3-to-1 ratio. We know that's not true, but to keep things simple, we're going to do that approach, just so we don't so much math to have to calculate. So Progressive, that does nothing but auto insurance, is at a 3-to-1 ratio, surplus ratio. The word writing means they're selling insurance. When we do this premium, this ratio, we're supposed to use written premium, but in our cases, we're just going to use earned premium. We'll talk about the difference between earned and written premium. But if you see that Progressive is writing to a 3-to-1 surplus ratio, they probably won't even say premium to surplus ratio. It means you take their net worth on a statutory basis and divide it by the written premiums. Okay, so we'll get into written versus earned here eventually. For return on equity, we're going to do net income or net worth. We're actually going to do net income over average net worth, so that unfortunately creates one extra calculation, but that's all right. Your K is required return to stockholders. Do we use book value or market value basis? The theory says use market value, but we'll actually use book value just to keep it simple. If you look at the price to book for most companies, so let's look at Allstate. So if you look at the price to book, by the stock market's up a bunch today. If you look at the statistics, the price to book for Allstate is at 1.15. So there's not a big difference between using book value and market value right now. You get very similar answers. If you do Hartford, HIG, you'll see probably I don't know how this industry is doing. Yeah, sorry, my computer is really slow. So yeah, I thought it would be an easy question to answer, but Hartford, sorry, HIG. Computer has issues. Anytime I'm in cam, yeah. All right, so there's Hartford and statistics. Sorry, everything on this computer is really slow. So their price to book is actually 0.75. We usually think of using market value will be higher than book value. They're actually trading at a discount right now to the accounting. You know, we think of accounting being conservative, but they're actually trading to a slight discount to their accounting basis. One thing to remember here, though, is when we say book value, we're talking about GAAP or versus stat. So in this case, we're actually talking stat book value, which is going to be lower than GAAP book value. So Hartford's price to book might be closer to 1-to-1. But the price to book is the value of the company from the stock market standpoint versus the value of the company from an accounting standpoint. The insurance industry historically has traded like 1.5 to 2, but after the financial crisis of 2008, they've been closer to the 1 area. I'd like to show you another company, but I'm just worried my PGR, let's see if it will. So Progressive is riding at a 3. So you see Progressive looks a lot more expensive, but Progressive is an auto insurer. It's not as hated by the industry as homeowners and some of the commercial lines. So there is some variety there. I wish I could show you later in the class. I was going to show you some of these ratios. We'll see if I can get access to Bloomberg so I can show you industry data, because it is pretty interesting. You'll definitely see differences between homeowners riders and auto riders and commercial riders and workers' comp. They're very different, and definitely title insurers. So price to book, you know, it's interesting. If your required return is 15%, you went through cap-in, you get 15%. If that's a required return, that's a required return on market value, not on book value. It's on market value. But if your price to book is 3-to-1, if your price to book is 3-to-1, and you're doing an ROE on a book value basis, so you're making 15% on a book value basis, where and stockholders require 15% on market value basis, and your market to book is 3-to-1, then you say you're making 15%, but your stockholders see you only making 5% because of that 3-to-1 ratio. So it's pretty important. All right, we've already talked through that. So let's actually do this. One thing we got to address before we get into this, we're going to do our return on capital not as net income over average equity. We're going to do is net income minus the change in required capital. The change in required capital is another way of saying the change in risk. We're taking on more risk. Because we're taking on more risk, our capital requirement went up, we're going to take that out of the value of this product. And it's almost similar to the concept of free cash flow. Yeah, we made net income, but some of that net income is going to be tied up in capital because our risk increased. So that's the one unusual calculation we have in there. And then we'll come back here and talk some about accident years and accounting years. We'll get into that more when we get into Schedule P. So if you go into Blackboard, and I don't have Blackboard loaded, but there's a file that's a pricing examples, P&C insurance pricing examples. Let me walk you through this. In the next class, we'll definitely do a few extra examples and get into this more. So what we have up here, CY, is the current year. And so NY, obviously, is next year. This year is not over yet, so this is probably current year forecast because you haven't finished this year yet. So you might be doing this filing, say, in March, April, May, and you have an estimate for this year. You've already got this year's premiums approved, and you're trying to figure out next year. So current year, your premium $750. That can be individual basis, $750, or it can be the entire company, $750 million. Your claims are $500 last year or current year. Loss adjustment expenses are $110. Your underwriting expenses are $120. If you take $750 minus these three things, you end up with $20. So when you load this file, you can see, in fact, that I'm giving you this file, it very much explains why this is going to be tough to put it on the exam as a question. Your required capital is $250. How do we get that? Well, we're using a premium to surplus ratio of 3:1. So you essentially take your premium and divide it by 3. So you get for every dollar you have in premium, for every $3 you have in premium, you want to have $1 in required capital. All right. Everything else down here are assumptions. So I will show you how I've done it in the past on the exam, even though your exam will probably look a lot different. So what we're going to do is we're going to take the current year and forecast it to the future year and then figure out what formula. Remember, we are going to back into it and use GoalSeek and Excel to get our premium. Actuaries have to use formulas that will give them this number. So I don't know how far we'll get, but let me just at least do this column. So the premium is what we're seeking, so that's why it's in green. All right, so last year claims were $500. What will they be this year? Well, look down here in growth in claims. Claims will go up because frequency is expected to go up. And frequency is usually the number of cars you have sold, how many miles driven, those type of things. Severity is in part inflation, or really mainly inflation. It could be more accidents happen, but a lot of severity, especially for auto insurance, a lot of severity is simply inflation, body parts, bodily injury, healthcare, those kind of things. So if you want to know how are we getting from this year's claims to next year's claims, we're going to take this year's claims and multiply it by 1 plus the frequency times 1 plus the growth in severity. So 1 plus the growth in frequency times 1 plus the growth in severity. And that's going to tell us that we expect our claims to go up from $500,000 or $500 to $535.60. Same thing on LAE. On LAE, we have frequency rising 3%. Usually frequency will be the same for LAE as it is for claims. It depends. With hurricanes and homeowners, you can get some differences. And then severity, I just use the same numbers here, but severity could be different as well because remember LAE, that's adjuster expenses. That also includes legal fees and other things. So the inflation rate there might be higher than the inflation rate somewhere else. And so the equation is the exact same thing. We take 120 times 1 plus the frequency times 1 plus the severity, and that's going to give us 117.83. All right, so we're trying to get, how do we incorporate frequency and severity? The total losses, I say times, but we're actually going to take, total losses is your frequency times the severity, but here we're looking at growth. So when you look at it from a growth standpoint, and my computer has frozen up, so sorry, I may have to just walk you through it, and then next class we'll actually do the full calculation. So we're saying the growth in severity. This isn't the actual frequency and severity. This is the growth in frequency, the growth in severity, and the growth and frequency and severity of LAE. So we just take that and increase it. For underwriting expenses, I just give you a percentage increase. That usually comes from the CFO area. What we expect your expenses go up. So I just increase that by 4%. When you do that math, you add up these three things to see what their total is, and you'll subtract that from the premium. What I did on exam in the past, you'd have two premiums, so you'd have to do that math twice. But if you add up these three things, they're going to be the same no matter what your premium is. So you only have to calculate these three numbers once and add them up. And so that gives us an underwriting gain of 1.49. And so, all right, since my Excel is frozen, I'm going to put this on pause and, well, look, okay, it looks like I'm back. Well, no, I'm not back. I don't know. Boy, it's really freezing here. All right, so we have to figure out the investment income. I'm going to real quickly tell what the investment income is, and then we'll work through it. So now we get to actually do float in reality. Remember, your first paper was about float. So what is float? So what we're going to do with float, so you have, yeah, I'm not sure that that's working. All right, my computer is absolutely frozen, so let me pause and see if I can get this. All right, so my computer is frozen, so I'll give you those formulas. But essentially what we're going to do for float is we're going to take, you have the current year times 1 plus the growth in frequency times 1 plus the growth in severity. So float is your current year claims, if we're doing claims, times 1 plus your growth in frequency times 1 plus your growth in severity. We're going to then divide that by 1 plus our investment return raised to the n. And the n is how long does it take us to pay these claims. If it's a short tail line, it could be as low as 0.5. If it's a long tail line, it could be, you know, who knows? It could be years and years and years. But we get our premium today. So remember, float is we get the premium today. We don't pay out claims until the future, and we're going to make investment earnings during that time. So that's what we're after. So the difference between our next year claims minus and the next year claims is going to be this. So the difference of that next year claims and the present value of next year claims, that's your float earnings. So that's what you're earning on float. That's your investment return on float. And so I'll have to get my Excel. It's broken right now. It looks like it's not going to let me back in. I'm probably going to have to reboot the whole machine. I don't want to lose this video. So this is an introductory. We'll see it. What we'll do next class, class 22, what we'll do is we'll walk through the entire process, and you'll see how these formulas work. This is probably the hardest part of the formula. It's pretty straightforward because you do it over and over again. It's the same thing with claims and LAE, and it's the same thing with expenses, except for expenses you only have one growth rate. But then you might have a different N. I tend on the problems keep the N's all the same. You might have a different N for expenses versus claims versus LAE. LAE tends to be a little bit backloaded because you have all your adjusters. Obviously, they don't start working on a claim until it's actually filed. So expenses might be kind of some up front, some in the back end. So the end's going to vary. I tend to keep that pretty simple. So what we'll do next session is we'll walk through an entire problem, next class, an entire problem, and you'll see how it all works, and then we'll do a two of them, and then I'll give you one that's exactly like the exam from last time and see if you can work that, even though the exam we do might be a little different.